So welcome back, class. This is question 4 of the CHRP paper. The financial year of Kinamba Traders ends on 31st December. The following information relates to the business. So we have that information relating to the business. Let me see the question. The question is required. Explain the accounting concept highlighted in each of the cases above. Explain the accounting concept highlighted in each of the cases above. Now we have the concepts, conventions, principles, all of them, will put them together. So let's see. Number one, the proprietor took 24,000 out of the business bank account to pay college fees for his children. This is the business entity concept, or the principle. It's actually a principle, business entity principle, which states that a business is a totally different, distinct, and independent from the ownership. So the business is, if the business is here, the owner is here. These are two different parties, completely different. We cannot mix the business and the owner. Business and ownership are totally different. What is business? We treat it as business. What is personal? We treat it as personal. So we cannot bring the two together. That is the business entity concept. So if the proprietor takes 24,000 of the business out of the business bank account, then we have to treat it as such, that he has actually withdrawn from the business for his personal use. We have to show that money has exchanged hands from the business to him, and that is the business entity principle. Up to last year, the machinery and vehicles used in the business had been depreciated using the reducing balance method. Yes, this is something we call the consistency, the concept of consistency. This is the whole thing. Consistency. That the way we are going to handle our business records this year should be the same in the next year, the other year. It brings in some element of consistency in our record keeping. So we should maintain a uniform way of dealing with dealing with that as a transaction. We should not keep on changing. This year we've done this, next year this, the other year that. No, it should be consistent. So the guiding item here is this. Up to last year, it means it's something that we've been doing on, and that is in line with the consistency concept. While reviewing his order book, the proprietor seems to be confident that the business will continue to operate in its present form for the next 100 years. This, without even blinking an eye, it's the going concern concept. Going concern concept simply assumes that the business, it's also an assumption, it assumes that the business will be there in the next so many years to come. And it is actually this principle that allows us to, to have the accrual concept. So we assume that the business will be there in the subsequent years to come. That is the going concern concept. And you can see, while reviewing his book, the proprietor seems to be confident that the business will continue to operate in its present form for the next 100 years. So we assume that the business will always be there. It has perpetual succession or existence. Then lastly, Kinamba Traders purchased a printing machine to be used in the business for the next 3 years. Kinamba Traders purchased a printing machine to be used in the business for the next 3 years. This will be the accrual concept. And accrual concept simply allows us to charge the costs that have been incurred in the respective years. So if you are going to buy a machine that will be used in the business for the next 3 years, then accrual concept allows us to charge the part of the machine that has been used in the first year for the first year, part of the machine that has been used in the second year for the second year, part of the machine that has been used in the third year for the third year. That is in line with the accrual concept, where we capture what has been actually used in that particular year as being the cost incurred. So the last part is actually an accrual concept, which states that the costs are captured as incurred and not as when paid. So we'll be able to get the cost that was incurred in the first year, second year, and the third year, or respectively, for that business. Then part 2 of the question. On 1st January 2021, Urembo Spa started business with 160,000 cash in hand. The transaction took place during the month. He deposited 100,000 cash into the bank account, bought equipment 40,000 paying by check. Proprietor took 12,000 for personal use, and then so required, enter the above transactions in the relevant ledger accounts. This one is so straightforward. So let's do it. This one, you just open the ledger accounts, and the ledger accounts are normally the T accounts. So we can have our T accounts. Let's have the T accounts. These are our T accounts. We can have the T accounts like that. So let's just have quite a number of these T accounts. Let's have a number of the T accounts. You can have the so many T accounts like that. So those are T accounts. Now then we have the, of course, the debit and the credit. All these T accounts, these are the ledgers. We have debit, credit, debit, credit, debit, credit. But don't draw this in an exam situation. Don't start by drawing this, because you never know. They might be filled up, and maybe you still need some space. So just go step by step. So on 1st January 2021, Urembo Spa started business with 160. And just before we start this question, it's good to be guided by this very simple rules. An increase in asset, we debit. A decrease in asset, we credit. An increase in liability, we credit. A decrease in liability, we debit. Incomes and gains, we credit. Expenses and losses, we debit. It's very simple. These are these very simple rules. So now let's go. On 1st January 2021, Urembo started business with 160,000 cash in hand. Yeah, that is complete like that. So he introduced 160,000 in form of cash to the business. So the two accounts that are affected, which is very important, you must identify the accounts that are affected. In this case, we have, of course, the cash account, which gained the money, and we have capital account. Capital account, money has been introduced into the business. So this becomes a liability. When you introduce capital into the business, it becomes a liability to the business. Remember, we said that you and the business are two different parties. So capital becomes a liability to the business. The business has to pay you your money, even if it's after 100 years. So being a liability, an increase in liability, because we didn't have capital, but now we have capital of 160,000. An increase in liability with credit. So we simply come here and say, on 1st January 21, the account that is causing this is cash account 160,000. And we didn't have cash. Now there's an increase in asset. Cash is an asset. So we simply say 1121 capital account, which is the account that has caused that 160,000. You can see debit and credit, and they are all balancing. Then during the month, January 4th, deposited 100,000 cash into bank account. So we withdraw money from our cash account. We took money from our cash account and took to our bank account. So we can open bank account. Bank account gained, cash account lost. All of them are assets. So when there's a decrease in asset, we credit. There's an increase in asset, we debit. So cash is decreasing because we are withdrawing 100,000. So we simply say on 4th, 121, bank account is the one that is causing this decrease. And then bank is increasing. So we say 4121, cash account, how much? 100,000. It's increasing because of the cash account. And you can see debit side, an increase in asset with debit. Then on 8th, bought equipment for 40,000 paying up by check. Bought equipment for 40,000 paying up by check. So come here, we paid by check. So money in the bank reduced. So we simply say on 8th, 1, 21, bought equipment. So we say equipment account. How much? 40,000. And then we come here, we open the equipment account. Equipment account. And since equipment is an asset, we simply show it on the debit side. 8121. The reason for it increasing is the bank account, which lost 40,000. So you can see this on the debit, bank is on the credit. The asset has increased with debit. Asset, the bank has decreased with credit. That's how we go about it. So I'm seeing the debts are lost. Possibly we can just come up with our debts. Let's assume those are the debts. Sorry for that. So on 20th, proprietor took 12,000 cash for personal use. On 20th, proprietor took 12,000 cash for personal use. So cash will reduce. So 20th, 121. I think I can get this question paper. Let me see if I can get it. So we don't have the question paper. Okay, so let's just proceed. I'm assuming this 20th and 20th, we'll just put the correct dates. So on 20th, proprietor took 12,000 for personal use. So this is what we call drawings. Drawings. Remember what we've said, that this is money taken by the owner for personal use. So we will treat it as a loss to the business. Losses are actually debited. So here, cash will reduce because he took cash 12,000. Then we'll come and open this drawings account, which is a loss, and losses are debited. So we'll say, and you can see this on the credit side, so automatically it means this side will have it on the debit side. Cash account, how much? 12,000, like that. Then lastly, the proprietor brought in personal equipment valued 18,000 for business use. Personal equipment valued 18,000 for business. It means he introduced capital, but in form of equipment. So we'll come here and say capital. On 28th, he introduced, this was his equipment. So we'll say equipment, he has introduced capital in form of equipment, 18,000 shillings. So we come here, equipment has gained. This is an increase in liability. So we come here 20th, 121. We say capital account, how much? 18,000. So we are done. We are done. So the next thing is to close this account. How do we close? Get the side with the highest figure. It will act as the balancing figure. So here we have 160,000. Here we have 160,000. The difference is 48,000. So you simply say 31st, 121. Balance carried down is 48,000. Then you come here, you show how it will appear in the next financial period. And we normally talk of balance brought down, 48,000. This, when it crosses, it becomes a debit. So here we will just close. The total is 58,000. We don't have anything on the credit side. So this will be a balancing figure. Then you say that first 121 balance carried down is 58,000. Then we come here, we say 1,221 balance brought down is 58,000, like that. Then here 12,000, we just close 12,000, like that. Balance carried down 12,000, and this is on 31st 1. Then on first, second month, we say balance brought down 12,000, like that. Then we come here, we close this one also. The total here is 178,000. 178,000 becomes our balancing figure this side. So we say 178,000, balance carried down, and then 31,121. Then here, how it will appear in the following, you can see this balance carried down is on the debit side. So it will appear, balance brought down will be on the credit side. So balance brought down 178,000, like that. Then here also we close 100,000. Notice the two lines, 100,000. That is the balancing figure. The difference is 60,000. So this becomes our balance carried down 31, 1, 21. Then 1, 2, 21 balance brought down 60,000. So we are done. But we can also, just as by the way, we can also just draw what we call, let's extract a trial balance. And whose books are these? These are Urembo Spa. Let's extract a trial balance. Urembo Spa, we'll say Urembo Spa trial balance as at the 31st, 1st, 2021, like that. And then the trial balance normally has two sides, the debit and the credit. So we'll have it like that. This is particulars, then we have the debit, then we have the credit. So how do we come up with this? Just follow the instruction. We normally pick the balance brought down figures. So cash account, balance brought down figure 48,000 on the debit side, 48,000 on the debit side, 48,000 on the debit side. So you simply come here, cash account, 48,000 debit side. Then you go the next one. This is equipment account, 58,000 debit side. So you simply say equipment account, 58,000 debit side. Then you go the next one. Drawings account, 12,000 debit side. Drawings account, 12,000 debit side. Then capital account, 178,000 credit side. Capital account, 178,000 credit side. We are picking the balance brought down, how it will appear the following month. Then bank account, 60,000 on the debit side. Bank account, 60,000 on the debit side. Let's add the total. It should automatically balance because for every transaction, the debit and the credit must always be equal. So this one is straightforward, 178,000. Let's add this side. 60 plus 12, that is 72. 72 plus 58, that is 80, 130. 130 plus 48, 178,000. So it's balancing. So this is what was expected of you in this question, and you'll earn your 10 marks. Then the first part will also earn your 10 marks, and you'll be good to go. That is 20 marks. So thank you. Do a lot of exercises. You never know what will come next time. Let's meet in the next question.